I joined an asset management firm, I dare say about 30 years ago, that helped define the concept of small cap investing. I joined a fund that was started in 1970, and at that point the idea of segmenting the market by capitalization was very new. And when I joined it in the mid-'80s, it had only $225 million under management, which was a great deal of money in those days. And it was invested exclusively in the U.S. And the dollar was extremely strong. It peaked in 1985, and the people running the fund were interested in diversifying outside the U.S. And I raised my hand and volunteered, and the rest is history. We have a globalized world now. At that point in time, investing outside of your home country was racy and unusual. And today, I think about my children, my daughter currently is in the Gulf. She's in Dubai, and she went there for a weekend from Boston. So the world has become very globalized, and the asset management business has become very globalized, and the number of equities that trade globally has exploded, and 90% of them are small to mid caps. So the pool that we have to choose from has become much, much greater. I think one of the most important changes, since 2000, but particularly since 2008, is that the asset management business has matured. To some degree, globally, it's gone ex-growth, and there has been a concentration of capital both on the side of the allocators, meaning the people who give the money out. We see this more in the United States, I would expect, than in Australia, but also on the side of the managers, and that is the bigger funds have become even bigger. 50% of all money managed now in the U.S. is in mega cap funds, and they are attracting 80%, of the marginal dollar. And that means that small caps, if you have a fund that has in excess of $10 billion under management, you cannot responsibly invest in the kinds of names we invest in, because you can't make them big positions. At the same time, because so much of the money is in large funds, it means that the sell side doesn't cover the small caps anymore because they can't get paid. So so for us, our strategy has diseconomies of scale. You need to be capacity constrained to invest in small to mid cap stocks. You need to put a cap on how much money you will invest, and as a consequence, because of the evolution of the asset management business as I've just described, you need to be able to do your own work. And I think that's really what firms like ours bring to the table. Independent research, extensive due diligence, and a focus on a universe that is increasingly underowned, underfollowed, and misunderstood. Well, I'll give you an example of a company that we just recently bought for the new fund that we're launching. It's one of our bigger positions. It's a Japanese company called Broadleaf. It's got around a $400 million market capitalization. We found it because we screened for Japanese companies that had very, very little sell-side coverage, if any at all, and we came across this one, and there were a number of names. Well, half the Japanese market has no coverage at all, so there was a lot of companies on the list, but this one popped out. So what's interesting about this company is that they have the definitive database for used car parts for all of Japan going back. It took 30 years to build this database. So you bring your 1998 Lexus in, and and the brakes aren't working, and the auto mechanic will pay this company to look on the database to find out the exact number of the part that he needs. Okay, and so this has been a database that has dominant market share in Japan and is essentially irreplaceable. All right. What is interesting about this business is that it was a management buyout, and a U.S. private equity firm came in and helped them develop a strategy. They raised prices, and they had no churn whatsoever in their customer base. So you have a business with great pricing power, you have a business with a dominant position, and here's the kicker. We bought it at about a 9% free cash flow yield. So we bought it at a price that we thought, well, we think, we have great downside protection because it's an extremely stable revenue stream, an extremely stable customer base, and a mission critical value. So historically, you would look up the auto part on their database, and it would tell you who has that part. And then you would go and call them up, or you would fax them an order, and you would find the part, etc. They are now making this interactive. So you actually can click through to the person who has the auto part, and via their database, order the part. And you charge a tiny amount of money to do that via their database. But what's really interesting is that so you have 70% market share, but only 1% of their revenue is now coming through this this feature where you can use them as the intermediary to actually access what you need. And we think this has huge upside. And so whether Greece exits the Eurozone, or whether there's another crisis in Iraq, we think that people in Japan will still need to fix their cars. And we think that this is a great long-term business, and we think we bought it at a price that gives us tremendous comfort as to long-term capital preservation. And that's a great example of the kind of thing, the kind of opportunity that we're very comfortable with. And whether the price bounces up or down, we're not worried about it long term, if we got it right. And if we didn't get it right, and we monitor this very carefully, we'll readjust.